Hello guys, welcome to another video. Today we are going to talk about accounting for lessee, and especially I'm going to talk about accounting for short-term leases. Actually under US GAAP for lessee we have three types of lease. One is called finance lease, second is called operating lease, and third is called short-term lease. How lessee can classify either finance or operating or short-term lease. So there are lease classification criteria is there. So just I want to repeat quickly because then we can proceed with the calculation. So guys, there are five criterias are there. One is called TET, I mean say transfer of title. Second is called purchase option, and the third is called 75% test. Fourth is called 90% test, and the fifth is called specialized. Asset is specialized. Okay. So what is the TT? TT means to say transfer of title. Like if the lease transfers ownership of the leased asset to the lessee by the end of the lease term, it means there is a transfer of title is there. If this condition is not there, so you should check the purchase option. What is the purchase option? The lease includes an option to purchase the lease asset. Okay, the leased asset that the lessee is reasonably certain to exercise that option. It means this purchase option, it could be with the lessee. He can buy this asset at the end of the lease period. So that is called what the purchase option. So purchase option means to say here you have option to buy the asset, and lessee is reasonably certain that he will exercise this option. Okay. So if this criteria is also not there, then we have to check the third criteria, which is called 75% test. Here it means the lease term is for the major part of the remaining economic life of the leased asset. Like what you will do here, guys, simply you will take lease term, I mean say lease duration, divided by economic life of the asset times 100, and you will calculate the percentage. If lease term, for example, is 4 years, life is 5 years, times 100, so it is going to give you almost 80%. So this, it means 75% test criteria is met. If this criteria is also not there, you have to apply 90% test. What is the 90% test? Actually, under the 90% test, what we will do, we have to calculate the present value of lease payments. Okay, we have to calculate the present value of lease payment plus the present value of residual value guaranteed by lessee. So it means GRV by lessee. And we have to calculate the present value of these values, and we will divide with the fair value. I mean, so we need a present value divided by fair value of the asset times 100. If asset, if the present value of lease payments plus GRV is greater than 90%, so we say 90% criteria is met. Okay. So what is 90% criteria? Actually here, if the answer is more than 90%, so it means the present value of the lease payments and the residual value guaranteed by the lessee equals or exceeds substantially all of the fair value of the leased asset. So if this 90% criteria is also not met, then you have to check the asset is specialized. The leased asset is so specialized that it is expected to have no alternative use for the lessor at the end of the lease term. Like if asset is not having any alternative use for the lessor, if the asset will return back to the lessor, so we say it is specialized asset. Now the point is, guys, so what we studied in the last video, I just have recapped. Just let me fit into this definition. If any of the five criteria is met, like these five criteria, transfer of title, purchase option, 75%, 90% are specialized. If any of the criteria is met, we say it is a finance lease. If no criteria is met, we say it is a operating lease. But this is really important, the short-term lease. For the short-term lease, we have overall three conditions under US GAAP. The first condition is what? If no criteria is met, I mean, so there is no transfer of title, no purchase option, no 75% test, no 90% test, and asset is also not a specialized, plus duration of lease is less than 1 year. Okay, plus company has elected as a short-term lease. Okay, if for example, maybe no criteria is met, this is there, duration of lease is also less than 1 year, but company has not elected as a short-term lease, then it is classified as operating lease. So to classify as short-term lease, so these three conditions must met. So whatever it's written here, like lease, no criteria is met, plus duration of lease is less than 1 year, plus company has elected as short-term lease. So guys, we can start now accounting for short-term lease. Now under IFRS, there is a one lease classification is there, which is called low value lease. Like if lease includes any asset whose value is less than $5,000 or equal to $5,000, that is called low value leases. And their accounting and our short-term lease, our means a US GAAP short-term lease accounting, and under IFRS low value leased asset accounting is it's the same. Okay, so what we are going to talk do here, please focus with me. Here we go, how you will deal with the short-term leases. Guys, here we have a note. Under the short-term lease, as lessee, we will not book any right of use of asset. Like we will not book any assets, and we will also not book any liability. So it means it is a off balance sheet financing. Even you are taking the means benefit from the asset, but this asset and liability you are not going to record into your balance sheet. So simply what we will do, as a lessee, whatever installment or rental we are paying, so we will simply record as a expense at the time of occurrence. Of course, this expense will be recorded in the income statement. Okay, guys. So what entry you will pass when you will incur the rent expense? So you will debit the rent expense and you will credit the cash or rent payable, that means say accrual. Okay, so IFRS difference I have already told you. So if under IFRS you have low value asset leased, okay, I mean say asset with the value of 5,000 or less, it is similar to the short-term lease, whatever we are studying in this video now. Okay. Now, guys, here we have an example. Let's have a look with the help of example how to deal with the short-term leases. For example, on October 1, year 1, Gulf company entered into 1 year lease contract for its warehouse. It's a 1 year. And it elected not to recognize the right of use of asset or lease liability for the short-term lease. It means they have elected it is as a short-term lease. Following are the lease term. Okay, we have a lease terms word. The first point, the first 2 months are rent-free. Guys, actually you have entered into lease on October 1. And first 2 months are rent-free. It means October plus November. These 2 months are rent-free period. Even if it is rent-free period, it doesn't mean you will not record any expense. So you have to record the expense on accrual basis, and I will tell you how to do it. And second is what? Monthly rent from December. Rent will start from December of year 1 to September of year 2, $3,600. This is monthly rent. It means if this lease is for 12 months, the first 2 months are rent free, which is include October and November. Okay, and from December till September of next year, so there is a rent of $3,600. Okay, so how you will do it here, guys? Because under the rent-free period in the month of October and November, still you need to record the rent expense. Okay, and how you will calculate it? So here we have a small calculation. So please, you have to focus here, guys. First of all, there is a monthly rent is there, $3,600. And there are total 10 installments is there, which is going to start from December till September of next year. So these are 10 installments. So it means you will pay total $36,000. Okay, this is what you are going to pay for this 1 year lease. Now what you will do, simply we will take this $36,000 which you are going to pay divided by 12 months, because lease duration is 12 months. So you will divide with the lease duration. So it means your monthly rent expense should be $3,000. So what you will do here, guys, now you will record every month your rent expense with $3,000, not with $3,600. So how you will do it here, guys? So entries, what entries you will pass in the month of October and November, because these 2 months are rent-free period. So what entry you will pass? You will pass double the rent expense 3,000, and you will credit the rent payables accrual basis 3,000. Okay, guys, because it is not yet paid, so you will start payment in from the month of December. So this same entry you will pass in October, and the same entry you will pass in November. So it means your total accruals in the month of October and November is 6,000. Why? Because 3,000 you have recorded this accrual in the month of October, and 3,000 of accrual you have recorded in the month of November. So total is 6,000. So this accruals you have to eliminate, you have to write off over the remaining period. How you will do it? Let's have a look. Now, guys, because from December we are going to make payments. Okay, from December till September of next month, next year, I would say. So total 10 payments you are going to make. So what you will do every month now, of course, in month of December also, you will debit the rent expense with 3,000. Okay, the same entry you will pass in the month of December, January, February, March, April, May, June, July, August, and September. Same entry. Okay. So you will debit the rent expense with 3,000 because we have calculated monthly rent here. If you can look at here, 3,000 here, right? Per month rent you have calculated. So you will debit the rent expense with 3,000, and you will credit the cash because you are actually paying cash of 3,600. So you can see here there is the difference on the debit side. 600 is the difference. So what from where you are going to get this $600? Actually, guys, because you have booked in the month of October plus November, you have booked the accruals, right? Accruals of 6,000. So this 6,000 you will divide with the 10 months now because October, November has passed. 10 months means say from December till September. Okay, 10 months. So you will get equally every month you will get 600. So with this 600 you will eliminate or you will reduce your liability over the remaining period. So this is what you have done here. You will debit the rent payable by 600. Okay. So now I hope, guys, this entry is clear. Now in question, maybe he will ask you, what is the rent expense in year one? I'm assuming our year end is 31st December. Okay. And you have entered into lease in the October 1st. It means from October 1st till 31st December, we have 3 months, right? The month of October itself, November and December. And you have recorded monthly expense of 3,000 times 3 months are there. It means your expense in the first year, I mean, in the first 3 months, which falls in the first year, should be $9,000. Okay. And if they will ask you, what is the rent expense should be recorded in year two? Of course, we have monthly rent 3,000 times in next year, 9 months are going to fall. Okay. Like from January, February, March, April, May, June, July, August, and September, 9 months. So 3,000 times 9 months. So you will get $27,000. Please, guys, note. So under this is simply a rental agreement. In this short-term lease or low value lease, okay, so you will not record any assets nor any liability. So that is why it's also called off balance sheet financing. Okay, guys, I hope it is clear. See you in the next video. Thank you so much. Bye bye.